that what is income? Income is nothing but increase in my economic benefits in the form of inflows or enhancement of the assets. That is income. Expenses are what is going out, decrease in the economic benefits in the form of outflows or depletion of assets. Like depreciation is a depletion of asset. So therefore it is an expense for us, expense for the company. Now let us understand. Normally they are prepared for a period. They are for a period. When I'm using specifically, I'm using the word period, I'm not using the word year. Because in the Companies Act it is permitted to have accounting period more than or less than 1 year. But now in the Companies Bill 2008 it says it should be for only for 1 year, starting from 1st April and ending on 31st March. But in case of a new company, so it will be the date of incorporation till 31st March. But anyway, presently there is no restriction to end the accounting year at 31st March. It is the requirement of income tax. It is not the requirement of the Companies Act. But since the companies don't want to follow income tax separately and Companies Act separately, so they follow one standard accounting year. Otherwise, you can have, for income tax purposes, 31st March, you can have 30th June also permitted. But companies do not want to pay audit fees twice. So therefore, they use the one accounting year. Okay.
But if somebody wants to change the accounting period, then this period of 1 year will be defined.
It will be 15 months. It can be 15 months. It can be with the permission of the registrar.
Once in a while it can be.
It can be done.
Switch over.
Normally what happens is, which companies do this kind of a strategy, I'll tell you, strategically those companies which are under losses. Supposing इस साल आपका 1 साल में लॉस आ गया और पता कि अगले 3 महीने में थोड़ा ठीक हो गया तो कहते चलो एक्सटेंड कर रहे हैं तो छुप जाएगा थोड़ा लॉस. So these kind of tactics are adopted by those days actually are gone now. ये पहले बहुत किया जाता था, अब जरा थोड़ा सा कम होता है. That is there. Okay. Then P&L account, it reflects the profit or loss. Obviously, income on one side, expenses on one side, so net profit or loss will be there. Sales achieved or revenue earned during the year, it will be reflected. If you read profit and loss account, I'll give you. I've got some photocopies. We'll read the profit and loss account balance sheet together. I think we'll do that. Then expenses which are direct or it may be indirect expenses. I think you understand what is direct and indirect. You have to explain. Direct expenses are those expenses which are related directly. Supposing I'm a manufacturing concern. So labor, raw material, these are direct expenses for me. Electricity, in the factory it is a direct expense for me, but electricity in the administrative office is an indirect expense because it has to be apportioned over the whole period. So these are direct and indirect expenses. Salary paid to the labor, wages paid to the labor are direct expense, but salary paid to the administrative staff or the other people like finance or maybe the corporate office or the marketing people, that is an indirect cost.
What about in the service industry?
In the service industry, yes, that's a very interesting question. In the service industry, the entire cost of the labor, see, I'll tell you, those, if you are paying to the consultants, like you have some consultants, you are rendering service of what kind? Let us presume.
Design services.
Pardon?
Design services.
Design services. Okay. So any amount you are paying to the designers, that will be a direct cost. Amount paid to the account staff is an indirect expense.
No, okay.
It should be related to the activity. Business. To the business.
If the business activity is offering design services,
correct.
If our company is offering design services,
correct.
Then as you said, for the manufacturing industry, labor is direct. So in
here,
service industry,
correct.
The designers are direct.
Designers who are related to that particular activity will be direct cost for the company. Others will be indirect. Because you have to maintain the account staff in any case.
Yeah. Okay.
Designers, if you have work, you will appoint designers, others you will not have. So these are things. Okay.
It's something like support staff.
It's like support staff. Okay. Now let us see. Okay. Profit and loss before tax is known as, normally it is known as PBT. Profit and loss before tax. Then tax provision which will be there. Then dividend appropriation may also be there. So this is what the profit and loss account normally reflects, looks like. Okay, let's move on to cash flow statement. There's the third part. It discloses changes in the cash position in a given period. So changes in the cash position, it may be an increase, it may be a decrease in the cash position. Sources of cash, it reflects sources of cash from where when I say cash, cash means the bank also, bank account also. So don't get confused with the hard cash. Cash means the checks are also included. And the application and use of money. In fact, we should use the word fund flow statement. These are sources of funds, application of funds. Okay. Now, framework schedule 6, I think we have already covered this. Yeah, one is schedule 6, then you have to follow accounting principles, you have to follow accounting standards. SEBI rules are also there, notes to accounts are also there. Notes to accounts generally give the additional information. They are very informative. Actually, if you have to read balance sheet, please read notes to accounts first. Only then you will understand the balance sheet. Don't read the balance sheet first. Please go to the notes of accounts. I'll just read, sir, can I have this document? Yeah. I'll just read notes, a few notes to accounts. We'll have to find out. So can you find out where are the notes to accounts so that we'll read it? I'll proceed further. So yeah, can you read it? What is the first item?
States and income.
Yeah,
Notes forming part of accounts.
okay.
In respect of sales of sensitive products MS, HSD, LPG,
No, I think
domestic.
it will, this is for which company? Subsidiary company? No, even this is also a part of it. Actually, significant accounting policies. Yeah, yeah. See, now it's on this thing. Significant accounting policies, they have stated what we are following. Now, in the major heads, what they have given is fixed asset. Now, what is the policy they are following?
Land acquired on lease for 99 years or more is treated as freehold land.
So this is the policy they are following, that leasehold land for more than 99 years or more is treated as a freehold land, so accounting is done in that manner. Okay, intangible asset, now please read.
A. Cost of right of way for laying pipelines in capitalized as intangible asset and being perpetual in nature is not amortized.
Now it says it's a petroleum industry company. It says that cost of right of way for laying the pipelines. Today they have to lay pipelines, so they may be using the public land, they may be using the private land. So they have got the right of way of laying the pipeline. So right of way is also an intangible asset. Like to collect toll at the toll tax. To collect toll tax at the toll is also an intangible asset. It's an intangible asset for me. So this is what it has been done. Okay.
B.
The costs incurred on technical know-how.
Cost incurred on technical know-how, license fees relating to process design, plants, facilities are capitalized as
Intangible
intangible.
assets. So these are the policies which they are following for intangible assets. Then they are following for depreciation. So what are the major heads you can just read?
For depreciation, impairment of assets, foreign currency
Foreign currency
transactions,
translations.
investments, inventories, duties on bonded stocks, grants, provisions, explorations and production expenditure, retirement benefits,
Retirement benefits, how accounted for?
sale of products,
Research and
R&D,
development.
research and development, tax on income, contingent liabilities and capital commitments, accounting classification
So
of
this is
expenditure.
all information is there. The moment you read it, so you have to read this in notes to accounts and the significant accounting policies first to understand what the company is doing. And also read it in conjunction with the board of directors report. They will give you future outlook, risks, benefits, weaknesses. They will give you the policies. So that is very important to read it in total. Okay, now let's talk about accounting. Before we actually read the balance sheet, now let us talk about the accounting standard vis-a-vis IFRS. Now this is very important. I'll take only 2 minutes on this. Because IFRS is very important. Tomorrow if you are in the board and somebody says IFRS, you don't know what is IFRS.
2011.
Yeah. International Financial Reporting Standards. IFRS stands for International Financial Reporting Standards. In India, we are using accounting standards which are issued by, now notified by the central government. They are known as AS, Accounting Standards. In international world, there was a body which was known as IASC, International Accounting Standards Committee, which was later renamed as IASB, International Accounting Standards Board. They have issued International Accounting Standard, IAS they have issued. What they have done is, they have renamed IAS as IFRS now. So the old IAS, International Accounting Standards, they continue, The new ones which they are issuing, they are known as IFRS, and they are also revising the old IAS and they are becoming IFRS. So today when I say IFRS, IFRS includes the IFRS issued by IASB plus International Accounting Standards issued earlier. So this is what is included. Is that clear, or shall I explain it again?
No, it's okay.
Okay. Okay, I think accounting standards notified by central government must be followed, which is in India now. AS1 to AS29 notified by central government. Now, India is converging with the IFRS, and this convergence is to be achieved by 1/4/2011. So all Indian companies will follow IFRS from 1/4/2000 accounting years beginning from 1/4/2011. Accounting years beginning from 1/4/11. So that means for 2011-2012 accounting year, all companies will have to follow IFRS. That convergence is being achieved. So if you are, chairing the big companies, please train your accountants, please train your accounts department, please train your directors to IFRS, otherwise they will not be able to do it. It is a bit difficult thing to do.
So thereafter this AS1 1 to 29 would be abolished?
Now there is a catch in it, I will tell you. At present there are 37 international accounting standards stroke IFRS, because some are IFRS, some are IS, but they are, technically speaking, they are IFRS only.
Right.
There are 37 or 38.
Okay.
Okay. Then 11 Indian equivalent IFRS now cleared by ASB of ICI. Yes. What has happened is now our Indian Chartered Accountants, ICI, they are also working to converge it. Obviously they have to modify it. So they have already worked on 11 standards. So 11 Indian standards have been converted into IFRS. They have been cleared by their accounting standards board, ASB of ICI, and also the National Advisory Committee on Accounting Standards formed by the central government under the Companies Act. So they have been cleared, but they have not yet been notified. They say, okay, now we feel that what you have done is a good job done. Okay. Now let us look at, but to adopt, now this is a catch. To adopt IFRS, you need amendments not only in the Companies Act, you need in the banking laws, insurance laws, SEBI mutual fund regulations. Because today the insurance companies are following different standards, different accounting policies. Bankings, some accounting standards are not followed because like disclosure of their NPAs, non-performing assets, they are following different guidelines. They are following RBI guidelines, they are not following Companies Act guidelines. Similarly, insurance companies have been exempted and they are following according to IRDA or whatever their regulatory body is there. So SEBI also, they have got different ones. So this requires amendment. Is not an easy job. It's not an easy job. Now reports which are relating to amendment of laws, they have been prepared by ICI. ICI says they have been forwarded to these bodies also, and they will also pursue with these bodies to amend laws appropriately before 1/4/11. I don't know whether it will happen or not, but yes, government is keen to converge. So what is important is that all the chartered accountants and the accounting staff must be trained to be IFRS compliant. Otherwise, the companies are going to be in difficulties. Okay, what are the benefits of adopting IFRS? They say you can access, once you are IFRS compliant, you can access the foreign capital markets, you have a lower cost of capital, you have a global reach of brand, you can escape multiple reporting, you can prove value of acquisitions, so these kind of things are there. Why I am saying escape multiple reporting? Because today, Indian company which is listed in New York Stock Exchange, they have to prepare accounts in accordance with the Indian accounting standard, and then they have to convert into IFRS also. So US GAAP is there, different, Indian GAAP is different, then this IFRS are also there. So everything is to be converged.
Is US GAAP also converging with IFRS?
Oh yes, they are.
By the same time?
By the same time. Accounting service hub, like India will become an accounting service hub, because then we can convert their accounts, outside accounts, to the IFRS compliant, and we can send it back. So it's an outsourcing which we can do. So these are the benefits. Okay, now let us evaluate the financial state. Let us come back to this. Now when you have to evaluate, first you have to select the information. Suppose I have to read the balance sheet, or I have to analyze it. Now reading the balance sheet is there, what we have discussed. Now I have to evaluate those financial statements also. How to evaluate? First step is I have to select what I want to evaluate, what I want. Supposing my objective is, okay, whether this company is profitable or not. I want to know this. So I will look at what? Profitability figures only. I need not look at the balance sheet. I look only at the profitability figures. I have to look what is the company's leverage, whether the company is leveraging its assets, turning its assets, what is its turnover ratio, inventory turnover, debtors turnover, in how many days the company is paying. So what is the time gap? So those kind of turnover ratios will be calculated. So and so forth. So therefore, we'll have to select the proper information. Then I have to highlight the relationship. What is the relationship between two? Supposing I want to know profitability. Okay, which are the two figures which you will take? There has to be one numerator and one denominator. So what will be what? Tell me.
Gross profit and
Sales
net
profit.
Either it can be a GP ratio, gross profit ratio, or it will be net profit ratio. Okay, on the top it comes net profit. On the bottom, what will come? You will divide by what?
Sales.
Turnover. So sales. So I will compare, if I say profitability margin, that means the profitability ratio means profit compared to sales. Supposing this year I compare and say I have earned 15%. I'll compare it with the last year, whether it was more or less. So I'll get to know about the company, whether the company is on the rise or is coming down. So this is what we have to do. What we tell is that we have to do some comparison. I'll just pass on certain documents. So take one and pass on the other one. You can share. Yes, sir. No issues there. Sure, sure.
It will take, sir, at least 6 hours to reach to Surat, sir.
Absolutely, no issues. Okay, everyone has got it?
Yes.
Any extra copies? Now, this is the income statement. I think we'll read it a little bit later. I'll just tell you what is what. So let us, this is first one is the income statement and the second one is the balance sheet. This is only, we'll just go through it. Now then we have to, I think we'll deal with this within 2 minutes. Just keep it with yourself. I'll just come to this. We'll read it together.
Okay.
I'll make sure that you understand it. That's my job today. Okay, then interpretation, you have to infer and then you will conclude. And then what it serves is, it serves as a warning system. How it serves, I think I'll tell you about that. Okay, how to analyze. Now first is the financial ratio analysis. If you have to analyze any financial statements, there is a one important tool which is with us is financial ratio analysis. Ratio analysis is what we call it. This is very important. And the second one is that is funds flow analysis, and it could be projections. When we project that what the company will do in future, and then there is obviously a comparison which has to be done. So these are the ways to analyze the balance sheets. I'll certainly go through it. Comparison can be inter-unit. Supposing the company has got 3 factories manufacturing the same thing, so inter-unit comparison can be done. It can be intra-industry, or it can be inter-industry also. So these are the, now this is important, horizontal and vertical analysis. Now this is most important. Are you aware about horizontal and vertical analysis? Okay. Now horizontal analysis means if we evaluate the trends over the years, 2009 compared to 2008, compared to 2007, compared to 2006, nothing but horizontal analysis. We are analyzing horizontally. Then vertical analysis, within the same year, vertical analysis which is done. Over of course the different number of years, but within those, that year what happened, I'll come to that. Now let us look at the page number 3. Page number 3 of the document which I have given you, it is nothing but the horizontal analysis. So if you are on the board of the company, please get it prepared the next day. You'll get many things out of it. Now this is horizontal analysis. It says 2005 compared to 2006 compared to 2007. What I've done is 2005 is treated as 100. The base is treated as 100. Then we look at 2006, what happened, like stock. Let us take first item. Stock increased from 100, that is a base, to 49. 49% increase is there. Now I have to analyze reasons. See, this should trigger further questions. This is not the end of it. Calculating horizontal analysis is not the end of it. Now it should trigger further questions. It increased to 165. That means it increased 65% over 2 years. And my total current assets increased from 100% to 154%. That means 54% they increased over a period of 2 years. Now, if the stocks increase, do you think it's a good sign or a bad sign?
Bad sign.
Why do you say it is a bad sign? Supposing,
Not
point is, now today, if you are saying it's a bad sign, I think on the face of it, this is not correct.
Yeah.
Whether it is good or bad, it has to be a relative concept. Supposing my turnover has gone up by 70% and my stock has gone up by 50%, do you think is it bad?
Good.
Then it is good. So it really depends.
More efficient. Yes.
So prima facie it seems that our stock has gone up by 65% in 2 years. But we don't know whether our sales have gone up. Let us look at those situations also. So now I have written certain questions down below that looking at these figures, now these questions are triggered in my mind. What are these questions? Why is there an increase in the stock of the company? Has the company changed its inventory policy? Or their answer could be that the company is unable to sell, so it is accumulating its stock. Or if the sale has gone up, fine, then it is fine. So answers will come, which you will evaluate whether it is good or bad. Then why did the taxation increase so tremendously? Look at the taxation. Taxation has gone up from 100 to 194, almost double. So sales must have gone up, only then it will be possible. Otherwise, how? Was there any changes in taxation? Is it reflected in increase in sales or profit? Profit should have gone up. Why is there an increase in the fixed assets and at the same time decrease in the long-term debt? Now this is most serious. On the one hand, if I increase my fixed assets and on the other hand there is a decrease in my long-term loans, this is bad scenario. That means I am financing my assets out of my working capital, short-term funds, which is a very bad scenario in accounts or in finance. You look at the balance sheet in two ways. On the top, fixed assets, current assets, fixed loans, or maybe the fixed capital and the working capital. On the left hand side, the liabilities. On the asset side, this is the thing. Now, fixed assets should be financed out of the fixed capital. They should not be financed out of the working capital. Vice versa is possible. Fixed capital can fund either the assets, it can fund even the current assets. But this is not possible. If this is there, that means there is something wrong in the company. So this is what should trigger further question. Okay, let us look at page number 4. Now this is vertical analysis. In this, what is 100? Total assets I have taken as 100 in every year. Look at, this is the difference in the analysis. Total assets have been taken as 100 in every year. Then we have seen the percentage. It also tells the same story. Now look at it. If you compare the previous chart, like stocks, in the previous sheet, it said that there is an increase of 65%, isn't it? Yes. From 100 to 165. So it triggered our question. But today, if we look at the assets, it is only 39%. And earlier it was 33%. So the jump is not that much. So therefore, that means the company has increased its sales also. So if we look at both the figures, both the comparisons, then the answers also start coming in. So wherever the answers are not there, these questions have to be asked objectively in the board of directors meeting. Yes, sir, iska answer de dijiye. Correct. Now let us look at further. Now this is the next page, page number 5, gives you certain ratios which are there in the slides also. I'll show you how to calculate. But of course, how to calculate is not important. To understand the ratios is more important. In fact, I've got a Excel template in which the entire working is done. You have to just feed figures, it will calculate ratios for you. I've given the soft copy to them so that you can develop the model. You just feed figures, take it from the balance sheet, all ratios will automatically be calculated. So that job, cumbersome job is gone, so you have to just analyze the ratios. Now let us look at page number 6. Now this is important, this is a case study for you. Okay. Just look at the balance sheet of this company's company A and company B, and also the turnover figures which are given underneath. Study it only for 2.5 minutes. I'll give you 150 seconds, and then give me an answer to a question. In which company you will invest, company A or company B? Keep the answer to yourself, don't disclose. I'll come to each and every